Bank of America is, of course, a household name as far as global banking is concerned, as far as equity research is concerned. Now, BofA has raised their year-end target for the S&P 500 index to 5,400 from 5,000 earlier. Let's discuss this and more. We have Savita Subramaniam, Head of Equity Strategy, US at Bank of America. She's with us here in the studio. Savita, great to have you with us.
Great to be here.
Thanks very much for coming
Thank
down.
you for having me. No, it's exciting.
So just tell us, Savita, the lay of the land as far as US is concerned.
Yeah.
I mean, actually, there is one market which has done better than the Indian market over the last 2 years. It's been the NASDAQ. It's been the US.
Yes.
Phenomenally well. But lately, there have been concerns about two things. One, rates are rising once again in the US. Second, the move is being led by lesser and lesser number of stocks, right? How do you respond to those two, and can this continue?
Yeah, so we've been in a very narrow market, and leadership has been entrenched in just, I think we call it the Magnificent Seven. Now it's shrunk down to the Magnificent Four, but, just a handful of companies that are driving growth. I think what happens now, and we're already seeing it to some extent, is a broadening out of the market. So we're seeing, like just in March, I think 60% of companies in the S&P outperformed the benchmark, which is well above prior months where it was less than 50%. So we're moving into a more normal market environment. But I think the driver is that one of the reasons this Magnificent Seven was so magnificent is that's where all of the earnings growth was coming from last year. So, as you look ahead, these companies, these IT companies, these AI plays are still likely to garner continued capex, but that growth rate is decelerating, whereas the rest of the S&P is starting to catch up. So our view is we're in for a broader recovery, higher highs on the S&P, but not necessarily from just tech, but other companies.
What about the second factor, which is rates? Almost 4.5%.
Right.
Will that be a headwind?
So rates, I think, are manageable for most companies in the S&P 500. And, think about it. Tech companies have net cash in many cases. So they're actually making money in this environment. Even the U.S. consumer is in a very interesting position where, most homeowners have locked in fixed rate mortgages. So they're paying very low rates on these long duration debt obligations. And then they're making more money on their money market funds. So it's this interesting environment where the Fed is really trying to slow down the economy, but they almost can't because consumers and corporates have delevered their balance sheets, have actually taken advantage of low rates to term out their debt.
Absolutely. By the way, I just wanted to focus a little bit on the market as well. We were telling you about how the market has hit all-time highs and fresh record highs. So that continues for the Indian markets. The earlier level was 22,619, and we are back at that 22,600 level. So, we're working really well for the Indian markets. But before we get to that, Savita, I just wanted your thoughts on the trends, right? You mentioned NVIDIA and, a couple of these other big AI trends.
Yes.
Tell me about what the next 12 months will look like.
Yeah.
Where do you see the big trend emerging now?
Look, we're already seeing trends shift from just the chips and the capex, the companies that are making the AI tech, to companies that are powering up the grid that we need for all of these chips to replace, people in all of these jobs. And then I think 12 to 24 months out, we start to see the productivity gains of companies like Bank of America or other service companies using AI to become more labor light.
It's largely in fintech, you think?
I think it's fintech, it's legal, it's IT services, and we've already seen this transform certain industries. In India, you know all about this. The call center model is completely obliterated by generative AI. And when you think about even in the US, the need for programmers has been completely reduced by the existence of generative AI, which can program for you. So I feel like this is just a moving target that basically can take out a lot of these service-oriented jobs, which sounds very bearish for the average consumer. I think that's the trick.
And for the average employee.
Yes, exactly. So if we all lose our jobs, we're not going to spend as much, and the economy is going to worsen. But I think there's a trade-off here where if you look at the U.S., the white-collar jobs are maybe more at risk. But within the kind of broader American spectrum, what we're seeing is this reshoring boom. So, we've had since 2018, we've seen companies move property, plants, and equipment out of other regions of the world, mostly China, back to the U.S. So I think that's the offset to the jobs going away in tech and financial services, is that there's this booming recovery in terms of actual manufacturing and infrastructure. The infrastructure bill that we have in the U.S. is similar to what we're seeing here in Mumbai. It's just, a booming economy, lots of refurbishment, and I think that could potentially stave off a broader economic slowdown. So our view is that the economic growth is, we've been bracing ourselves for this recession, and it never came. and now we're starting to see economists revise higher their GDP numbers. We're seeing consumption remain relatively healthy. So I think, the idea that we're in for this sort of shock and the market is in bubble-like territory, I wouldn't necessarily agree with it.
All right, Savita, good to have you in the studio. And I like the point that you made at the start, right? The broadening of the rally that we're seeing in the United States, and that's evident in the Russell 2000 as well. So good on that.
Exactly.
A couple of questions now. First, on the global front, I think you all are factoring in 4 rate cuts.
Yes.
What's the probability we get a disappointment on that front? Because the street seems to, on a day-to-day basis, we get news pieces, we're getting data points as well, which makes the picture even more muddled.
Right.
So if you could tell us in terms of Fed rate action.
Yeah, I think the risks that the Fed doesn't cut as aggressively as what's priced in is very high. And our economists acknowledge this as well. So, the idea is inflation hasn't necessarily been fully controlled. We're still seeing a very tight labor market, especially in this sort of manufacturing segment. We're still seeing high inflation prints. But, again, when I look at sort of where we are, I think even if the Fed remained on hold all year, and I know this is a controversial statement, I still think the S&P 500 could do pretty well. Because again, we're in a different landscape where the balance sheet quality, the ability of companies to handle higher rates is there. One of the things that we looked at was, what is the level of real rates that will really destroy the economy? And I don't think that we're there yet. In fact, in the 80s and 90s, we had higher real rates than where we are today.
Yeah.
And the market was doing well. Companies were focused on efficiency. So if we move back to that type of environment, I think that it could be still a very strong environment for equities, for the economy, et cetera.
That's an interesting point you're making. So maybe the street is fretting a little bit too much with regard to what the Fed does next. Maybe in fact, if they don't cut as aggressively, it may be par for the course. Where does all this fit in terms of India? We are thumping the table. We're going to get earnings growth, stable government, things looking up here. But we're ignoring a couple of risks, like Brent crude prices moving up, political, geopolitical risk as well. Tell us more. How does India fit into this?
Yeah, so I think that India has some advantages versus the U.S. and some disadvantages. So one is energy independence. The U.S. has finally, kind of weaned itself off of importing oil and is fully independent. So it's no longer subject to the vagaries of oil prices, whereas India is an importer of crude, and that's clearly a risk, as it is for Europe and other major economies. But I do think that the demographic layout in India is much more attractive than in the U.S. In the U.S., one of the reasons that the labor market is so tight is that we have this aging population and these early retirees during COVID. So the demographic story is stronger here. And then I think the consumer trends in India are very exciting because when you look at this sort of middle class, there is a much longer runway for growth in that middle class consumption cohort. Yeah. So if we do see sort of what the seeds have been sown for, strong infrastructure spending, we're seeing consumption growth pick up, we're seeing iPhone sales, kind of clear, really skyrocket. So I think those are areas where we could actually see a stronger trend in consumption than where we are in the U.S., where consumers are already somewhat maxed out.
So just a point on that rates, right? If higher rates have not hurt, should lower rates help?
It's a great point. I think lower interest rates will help smaller companies, like the Russell 2000 probably needs the Fed to start cutting interest rates because there's more refinancing risk for those companies than big cap companies that have better balance sheets. But to your point, I mean, retirees are actually doing great in the US. They're making a lot of money on their cash and they have low fixed rate obligations. So, you know, and at some level, there is a pretty sizable cohort of the economy that benefits from rates where they are today. I think if rates move significantly higher, that might create more drama when it comes to refinancing the cost of
capital. On the way down, though, do you see portfolio flows moving towards emerging? If rates were to come down, dollar were to drop, I mean, the implication is more on flows towards EMs, etc.
I think
more money coming here.
I mean, my sense is that if we do see this sort of global coordinated recovery, we start to see interest rates come down in the U.S. Investors will become more price sensitive. They'll look for cheaper growth. The S&P is probably the most expensive growth you can find. So they'll move outside of the S&P to other areas of better growth at lower valuations. And I think India fits that theme perfectly.
I just have one final question. The point you were making to Nigel's question about the growing middle income market in India, right? With India's growth set to reach an average of around 6.7 to 7%, India will soon move from a lower income to a middle income economy in about 6-7 years. How do you play that? Do you bet on the consumption theme here? Do you bet on, because the luxury market is already growing, but has a time now come for the middle income or the, the affordable market to start growing as well? And if yes, how do you play it?
I think that, I think there's a theme there. I mean, if you think about in the U.S. or in China, well, in the U.S. it was, in the much earlier, but there is this theme around, kind of middle price point retailers. And even in the U.S., we're looking at areas where there is demand coming from the India consumer. So it's kind of like we used to watch the China consumer. Now we're watching the India consumer to see where the exports are the greatest. And those are areas where we expect to see growth in the U.S. markets, which is what I follow most closely.
All right, Savita, pleasure speaking to you. Thank you so much for joining us here in the studio.
Thanks very much.
Are you in India for a while?
Just today and tomorrow, and then I'm going to Kolkata, and so for about a week.
Okay, enjoy your stay here.
Thank you. It's wonderful to be here.
Okay, well, that's a word on the global markets and, of course, a view on India as well. Let's take a